Welcome to Financial Literacy for Directors of Not-for-Profit Organisations. This course will give you an overview of three main financial statements: the income statement, the balance sheet, and the cash flow. You will also learn how to interpret and question the three financial statements. A key role for a director is to ensure the financial viability of the not-for-profit organisation so that it can achieve its objectives. Many not-for-profits may have a treasurer, but this does not change the responsibility of directors to make sure the organisation makes effective use of its often limited resources, and also to ensure it continues to remain solvent. Directors are required to read and interpret financial information in order to monitor the financial health or position of the organisation, monitor operational performance, determine the right asset mix to maintain, determine the best way to finance the organisation, and to assess whether the organisation is solvent. Directors should be familiar with the following three financial statements: the income statement, the balance sheet, and the cash flow. We're now going to look at those individually. The income statement. The income statement is often referred to as the profit and loss statement. The income statement is designed to show how much an organisation has earned during the period. It will either be monthly or yearly. The income statement consists of revenue less expenses to provide a profit or loss. Not-for-profits tend to call this profit surplus and the loss a deficit. Then you add on any other income and less any expenses to give you a net profit. The revenue section of the income statement includes operational revenue from the sale of goods and services, plus other revenue such as interest received. In a not-for-profit organisation, the revenue may consist of sales of services, sales of a product, grants, fundraising, donations, bequests, volunteers, crowdsourcing, or investment returns such as income received. When reviewing the revenue section of the income statement, you need to consider the following. You need to assess asset trends over time and against budget. The organisation should be aiming to increase revenue levels. Management should be budgeting for an increase in revenue. Do you need to diversify revenue streams? How heavily reliant on grant funding is the organisation? Can you develop a social enterprise to fund your cause? A social enterprise is when you apply commercial strategies to maximise improvements in financial, social and environmental well-being. Are you investing excess cash to gain a better return and more interest income? How does the organisation manage and utilise fundraising, bequests, donations, volunteers, or crowdsourcing? Do you understand the complexity of grants? Grants across a number of financial years should be properly understood by the directors. Expenses are the costs of running the organisation. Expenses can be shown either by function, for example, selling, administration, or by nature, for example, depreciation, staff costs, office expenses. Expenses consist of direct production expenses. For example, if you produce a magazine or run a store selling products, this belongs in the direct production expenses category. General overheads admin would be your office administration. You can group expenses to best suit your organisation. What should you consider when you are looking at expenses in the income statement? You should assess trends over time and against budget. Management should be aiming to be more cost efficient without impacting service delivery. You should also be comparing expenses to the budget. How did you go? Did you bring them in under budget or on budget? Or did you have an expense blowout and you were way over budget? Have all accrual entries be done? For example, you know you ran a big conference this month and you made lots of money from it, but have you got all the expenses in the income statement for that event? Did you fully acquit all costs incurred when reporting to funding bodies? What about any grants that you acquitted? Have you got all the expenses in against that grant? Could you share resources with other not-for-profits to reduce costs? Could you retain or attract more volunteers? Could you merge with other like-minded not-for-profits to gain economies of scale and reduce administration and overhead costs? When you look at the profit or loss, you need to consider that all organisations need to generate profits or surpluses to build equity in the organisation. Only when an appropriate level of reserves have been accumulated should the organisation operate with much tighter margins. When you're looking at the profit or the loss figure, you should consider the trend over time and against budget. Did you meet budget? Did you fall short of budget? Were you over budget? Some years you make money, some you lose money. Other income and other expenses. What do you put in there? These are really adjustments to financial information due to changes in the market. The most common are asset reevaluations due to changes in the real estate market. For example, you might have a building. It was valued at $1 million last year. This year, it is valued at $1.1 million. That reevaluation goes into other income. It also includes changes in foreign exchange rate and any changes in the value of share market investments. Income tax. Many not-for-profits are exempt from income tax. If this is the case, then there's no need to include a tax expense or a profit or surplus for the period after tax. So how do you interpret the income statement? Remember, the income statement measures the activity of an organisation over time, usually a month or a year. It follows the accrual accounting concept of showing the information in the period when the activity occurred, not when the cash has been paid or when it was received. For example, you have a big event in the month of September. All the revenue and the expenses associated with that event are recorded in the month of September. This is regardless of if you've paid all the invoices or whether you've received all the money. It also measures financial performance of delivering its goods and services. As a director, you need to be monitoring the financial affairs of an organisation and asking questions about anything that seems unusual or of concern. Some questions to ask may include, has the information for both revenue and expenses been shown when the activity occurred? Have any other accrual accounting policies been followed? If yes, do you clearly understand them? Are all expenses included? For example, has depreciation been included? Are there any bad debts to be written off? And what about employee on costs, unused annual leave and long service leave? Have they been included? All your donated goods and services included? Are there any unusual expenses? Is there a reliable budget, and is the actual information being tracked against the budget? If there is, are the significant variances explained? And do the explanations seem reasonable, or does something need to be done?